If you've been told your debt to income ratio is too high for a VA loan, this video could completely change that. Most veterans think VA loan approval is all about credit score and DTI. It's not. There's something called a VA residual income, and in many cases, actually more important than your DTI. Today, I'm going to explain what VA residual income is, how it's calculated, how the VA residual income chart works, and how it might help you qualify even if your DTI is above 41%, 50%. Let's break it down. I'm John Thomas, a VA loan officer with Prime Residential Mortgage, and I specialize in helping veterans understand their buying power before they start house hunting. One of the most misunderstood parts of VA loan qualification is the residual income requirement. So let's simplify it. What is VA residual income? VA residual income is the amount of money in income you have left over each month after paying your proposed mortgage payment, all recurring monthly debts. This can include things like car loans, credit cards, student loans, personal loans, child support, any required obligation, even your taxes on your paycheck. After those are all subtracted from your income, what's left is your residual income, and the VA requires that number to meet a minimum guideline. Why VA residual income matters more than DTI. Here's where VA loans are different. Most mortgage programs focus heavily on debt to income ratio. VA loans reference a 41% DTI benchmark, but that's not a hard cap. There is no hard cap on DTI for VA loans. If your DTI is over 41%, you can still qualify if your residual income is strong. In fact, if your residual income exceeds the required amount by 20% or more, that significantly strengthens your file, no matter what the DTI. This is one of the reasons VA loans are so powerful for veterans. The VA does not just look at percentages. They look at real dollars left in your pocket. How VA residual income is calculated. Here's how we calculate it. We start with your gross monthly income, and then we subtract your federal and state taxes, Social Security, Medicare, your payroll deductions. We take off your proposed housing payment, all monthly debts left. What's left is your residual income. Now, the minimum amount required depends on three things: your geographic region that you're purchasing the property, your household size, the loan amount. The VA divides the country into 4 regions: Northeast, Midwest, South, and West. Each region has a different required minimums on the VA residual income chart. For example, a family of 4 buying in the South has a different requirement than a single veteran buying in the Northeast. That's why its calculation needs to be done correctly early in the process by your lender. Why the VA uses residual income. The Department of Veteran Affairs designed this requirement to protect military families. Instead of just approving loans based on a percentage, the VA ensures you accurately have enough money left each month for food, utilities, transportation, savings, unexpected expenses. That's one reason VA loans historically have lower foreclosure rates. They're built for sustainable home ownership. Can you qualify with high DTI? Short answer, yes. Your DTI over 41%, but your residual income exceeds the guideline, you may still qualify. This helps veterans with large families, borrowers with student loans, military families relocating due to PCS, borrowers with variable income. VA underwriting looks at the full financial picture, not just one number like DTI, and says no. Common myths. VA loans are harder to qualify for because of residual income. Reality, residual income often makes approval easier than conventional loans because it allows flexibility beyond strict DTI caps. Myth, residual income replaces credit score requirements. No, credit and income stability and documentation still matter. Residual income is one piece of the approval puzzle, but it's a powerful one. Why work with an experienced VA loan officer? This is really important. Residual income calculations can be detailed if income is miscalculated or deductions aren't documented correctly, or if the worksheet for residual income isn't even filled out, it can delay underwriting. That's why working with a dedicated VA lender matters. As a VA loan officer, I run residual income analysis early, so there's no surprises later. We look at your income, your debts, your target purchase price, the region, the household size. We determine your true buying power before you even go shopping with our pre-approval. That's how you win in this market. If you're thinking about using your VA loan benefit and you want to know, do I qualify? What's my buying power? Is my DTI too high? Can I still qualify? Do I meet the VA residual income requirement? Let's talk. We can schedule you a free VA loan consultation directly at calling me 302-703-0727. I'm John Thomas with Prime Residential Mortgage, and I specialize in helping veterans use their VA benefit the right way. If this video helped you, hit like, subscribe, drop your questions in the comments, and remember, don't let one number stop you from exploring your VA loan options. I'll see you in the next video.